A crisis hits the White House. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, panic just hit the top levels of the Biden administration as the unimaginable just happened. And I want you to understand, we continue to hear from the political elites that the U.S. economy is booming on the back of a strong and robust labor market. And then now today, we just find out the unimaginable has happened, which is sending the Biden administration into full crisis mode. Now let's head over to CNN, where we picked today's story up from a Wednesday interview, and this is very important. We look back to an interview with Biden on the economy, and here we can see Aaron Burnett on Wednesday talked with President Biden as he's trying to highlight a plan to build up manufacturing and tech jobs in the Midwest. And remember, just the other day, we talked about how China is dumping products all over the world economy due to a lack of demand and overcapacity in their manufacturing space. So this is critical, because one thing that causes American jobs to go away is when cheap imports hit our shores, and President Biden is trying to do some damage control here. And on polling data that shows him trailing Trump on the economy, and whether he's running out of time to turn around the perceptions of the economy before Election Day, keep in mind, many people make their decision about the economy about 6 months ahead of the election. We're in that window now, and we've already turned it around, the president said. The polling data has been wrong all along. Well, hold fast. We got some new data today. As President Biden pointed to the polling data, he suggests a majority of people were indeed satisfied with their own situation. They think the nation's not in good shape, but they're personally in good shape, the president said. Now, do you agree with them? Weigh in the comments below. I'd love to hear from you. But let's continue on, because the White House advisors, who are now in crisis mode, have previously pointed to a University of Michigan survey that has shown a general uptick in consumer sentiment. And today, on Friday, and the timing of this could not be worse for the administration. We just got the preliminary data from the University of Michigan. I'll show you that in a moment. But regarding inflation, he agreed that people feel day-to-day pain in the increased price of groceries and other items they need, but he argued it is more about anger than being unable to afford things. They have the money to spend, he says. It angers them, and it angers me that they have to spend more. And he argued, before talking about corporate greed being responsible, and this is an issue because, of course, inflation eats away at the spending power of Americans, and what that means simply is the more money they have to devote to things like rent and energy and food is less money on the discretionary side of the economy that gets spent. Of course, when you drop that down enough, it leads to increased unemployment, and that is a dangerous sign, because as we've noted, first-term presidents that are coming up for election their second term, if they face a recession, the odds get somewhere near zero that they get reelected. A CNN poll conducted by SSRS and was released in late April said a majority of Americans, 70%, said economic conditions in the U.S. were poor, and that were similarly disapproval of President Biden's handling of the economy. On the subject of personal finance as well, it didn't agree with the president. Perceptions of their own finances also remain negative, with 53% saying they're dissatisfied with personal financial situation, while 47% are satisfied. And dissatisfaction is starkly prevalent among those with lower incomes, which is usually where slowdowns hit first, as 67% are dissatisfied with households and annual incomes under $50,000. People of color, 64%, say they're dissatisfied. And while younger Americans, who seem to hit the economy at the worst time, well, those 61% under the age of 45 say they are dissatisfied. But one thing that would help turn people's opinion around, well, if they could make some money. We show you how to do that in the markets. Let's take a look at some top trades going back a month, because I don't want to reveal some of our current great trades. You want to find out about that, there is a 30-day free trial. Check out the links in the description below, because let's go back to early March. We see wheat on our CTA Diamond Pro report. That trade up still today, 16%. How about natural gas? No one thought that would turn around. We got that nearly 10%. How about EWH up nearly 9%? And look at our Momentum Diamond Pro report. It crushes as well. Here we see wheat hit twice on the report, up on average about 14%. EWH also up nearly 10%. Now, how do we do that? Well, one way we do is we look at the machine positioning of the market, but what we do that's different than everybody is we run a historical overlay to show you when the machines are offside in deep short positions, giving you the edge to trade in before they buy. We give you a report and a video. Now, maybe you like to trade the technicals. Those are those momentum indicators, but you find yourself getting out early, and that is a problem because you get in late as well. We run a proprietary overlay. We give you a daily report and videos when the trade signals come up. We make it easy. You don't have to look at charts. You don't have to be an expert. You just have to put the trades, put your stop losses on, and let the reports do the work. Again, 30-day free trial in the description below. My friends don't even give you that because that would mean consumer sentiment would be way higher when people make money in the market. For the president, now we see it slumps as inflation expectations rise. We just got the University of Michigan data, and it fell to a 6-month low in May. And the timing of this, of course, was terrible compared to that interview. And now you're starting to see why the White House is in crisis mode, because they were banking their hopes the sentiment would stay strong. That has now changed in a big way. And it wasn't a small decline, as you're about to see. It slid to 67.4 in May from 77.2. Again, this is preliminary reading. The figure was weaker than all forecasts, as consumers now expect prices will climb at an annual rate of 3.5% over the next year, the highest in 6 months, and up from 3.2% expected in April. They see costs rising 3.1% over the next 5 to 10 years, up slightly from a month earlier. And what happens when consumers start to see their confidence decline? One has significant implications for the economy, and that is not good for the president, as the decline in sentiment was broad-based across age, income, and education groups, and also reflected growing concerns about high interest rates. While the labor market has driven economic growth over the last year, the downbeat assessment highlighted in the report as to evidence of a slowdown. Now, this is something that we've been making the case was going to happen. There's around 1.8 million people on continued unemployment claims today, and while historically that is low, when you look at how much the economy expanded after the pandemic, when you come off a very historically low print, well, it changes the dynamics of the economy, and that is what we're seeing the impact here. We've noted there's been some big corporate layoffs. They haven't shown up in the weekly claims, but now all of a sudden sentiment is changing and has everything to do with the labor market. As strengthened household incomes have been the primary support for robust consumer spending over the past couple of years, mainly due to government handouts. So softening in labor market expectations is concerning, and if it continues, may lead to a pullback in consumers' willingness to spend. And this is absolutely correct, because when people go to work and they see that there's not enough work for them and the other people, they see demand slowing down, they maybe see hours getting cut or some people laying off, what do they immediately start to think? I better cut my spending, I better raise my savings. And we noted just in a recent show that the savings rate was very, very low. And of course, that means because credit cards are tapped out, we know that consumers are having to pay back those 4-pay loans called buy now, pay later. And what we're going to see here, this shift in attitude and sentiment, is going to have serious implications for the economy. As the university's measure of buying conditions for durable goods, some of which are financed as they commonly are, decreased to a 1-year low. And you think about this, if durable goods, if consumers pull back on their spending, well, what does that mean for factories? Well, that means demand goes down. Demand goes down, backlogs get worked out, there's not enough new orders to sustain the workforce, people hit the unemployment line. And sure enough, that's exactly what the survey says as we look at consumer sentiment here against continued unemployment claims, that's shown in red. And consumers, they start to actually get sad, as you see here, as the blue line drops, when, of course, unemployment claims start to rise. Now, here is the current reading. Now, the preliminary data doesn't show up here, so that's what this red mark is. It was a steep drop over, of course, the final print from last month. But I want you to see, as consumers start to get discouraged about the economy, it happens to match with the labor market, suggesting that perhaps what we're seeing in the official unemployment data Well, things are about to change in a big way. Maybe people realize layoffs are starting to hit and it's just not shown up yet. That could be the risk. Or there are a lot of people that have lost their jobs that are getting severance and they haven't been able to find work, and their runway on their severance package is coming to an end. And if that does, it means their spending is going to stop too. And worse yet, consumers expect the pain to continue as expectations for interest rates deteriorate considerably this month. Only 1/4 of consumers expect interest rates to fall in the year ahead, compared with 32% in April, mainly due to Fed Chair Powell claiming that he's not going to cut rates anytime soon. But that's not where inflation expectations actually come from, because the Fed actually could care less what consumers think about inflation expectations. Here you see the University of Michigan inflation expectations in blue against the federal funds rate. You notice there's absolutely no correlation here. Again, the Fed makes its policy independent of what consumers think and actually cares more about what Wall Street thinks. And here we can see that really inflation expectations are driven by U.S. regular all formations gas price. That's shown in red on a year-over-year rate of change. And so here we can see gas prices on that year-over-year rate of change rising. And that means, of course, this is the final print, not the preliminary data that went higher, suggesting that consumers believe inflation is going to go up. And that is another issue here, because even if we don't see inflation rise, at least the consumer price space, if we see energy prices just stay elevated or even tick up a little bit, that again pulls money away from discretionary spending. So we start to see where the attitude, where the sentiment is coming from, is people are going to work and they're saying, wait a minute, this is not what I was promised. The economy was supposed to be booming here, and we're seeing demand continue to fall. It has everything to do with households. We see their income decelerating as we continue to look at, of course, total compensation growth slowing. We've seen that over the last couple shows we've done, against the fact that there's no sign the prices are going to drop enough to give consumers a break. The current conditions gauge declined to 68.8 while a measure of expectations. This is down the road for 6 months, 66.5, both 6 months low. Consumers across the board saying things are not going to get better. In fact, their perception of the financial situation, as well as short and long-term economic outlooks, decrease this month. And it just makes perfect sense. As we started earlier, when consumers feel less confident about the economy, they spend less, save more. Here you can see University of Michigan consumer sentiment in blue against advanced retail sales. That's shown in red on a year-over-year rate of change. And you can see hand in hand, they follow each other here, with the exception of right now. Confidence has been rising. People have been optimistic the economy is going to get better. But what did they see? They didn't back it up with their spending power. In fact, we've noted that the retail, not just retail sales going down, we've seen that, of course, savings rate has dropped. So consumers are struggling to keep up with inflation. They're struggling to keep up with their debt services. We know delinquencies across 30, 60, and 90 days of credit cards are rising, and they're optimistic. They wanted to believe, but now their beliefs are getting shattered as the economy continues to slow down. And this is one of the reasons, of course, we note that Biden now is set to hit China EVs as strategic sectors with tariffs. This is an attempt to protect the U.S. labor market. But one thing we've seen, at least from the automobile manufacturers, is demand for electric cars. And we'll soon see demand for cars overall is coming down. And this is all a move to protect U.S. jobs. But it will be too little too late? The answer is yes, because we're likely headed into recession to begin with. As the decision is the culmination of a review of Section 301 tariffs, first placed under Trump back in 2018. And the U.S. will impose new elevated tariffs that focus on key industries, including electric vehicles, batteries, and solar cells. Other existing China levies are expected to largely be maintained, and we're looking forward. Of course, we'll see that announcement perhaps in the days to come. As President Xi Jinping's strategy of ramping up manufacturing to arrest an economic slowdown at home, well, has triggered alarms abroad, and that makes sense because he has the power to do that, to say, look, you're going to build, you're going to produce, I'm going to keep people employed, and we'll just dump all this production in the rest of parts of the world, and everyone else is saying, wait a minute, we don't want your cheaper imports. That's going to drive inflation down, but even worse, it's going to drive jobs away, and that is the challenge here. as U.S. and European Union leaders have scolded Beijing over state support that they say has fueled a deluge of cheap exports that threaten jobs in their market. That is a key part. The EU launched an EV subsidy investigation in October that may lead to additional tariffs. Well, you can probably bet it likely will come to that conclusion, because here you can see producer prices, this from China in blue. I want you to know that virtually most of the time that you see deflation coming out of China, that's when that blue line is underneath that horizontal black line, with the exception of here around 2012 to 2016. Why is that? Well, interest rates were still low then. The economy was booming. But otherwise, look at this. You see deflation start to hit U.S. shores. What happened? Americans lose their jobs. And you see it happen again going into global financial crisis. You see it as we head early into the pandemic. China started exporting deflation. You see the effects on the labor market. And now we see that again. And that is the big concern for the administration, is they don't want to see the labor market go. The Fed doesn't want to see the labor market go, because if it goes, so too there's the chances of the president likely getting reelected for a second term. But the Fed's not going to run to the rescue, as Bowman says Fed should hold rates steady for a bit longer, and she's worried about credibility. Well, their credibility was something they never really did have. It is of utmost importance that we maintain credibility in pursuing our fight against inflation by proceeding carefully and deliberately to achieve our 2% goal. I think we need to be where we are for a bit longer, because, of course, we know historically the Fed doesn't move until stuff starts to break. They don't know when to quit. This is definitely one of those times they need to be looking at the data and start to make changes. And if we don't see progress on inflation, then I think we'll really need to be thinking about what we need to do from there. But if consumers continue to cut back their spending, Bowman, you're not going to have an inflation problem. You're going to have a recession problem and a financial crisis problem. And that means your rates are going to be back at zero faster than you can blink. As a series of policymakers this week have echoed calls for higher for longer, as Fed President Susan Collins said it will take more time than previously thought. Well, they never told us how long it would take to begin with to bring inflation sustainably down to the central bank's 2% target. In fact, Minneapolis President Neil Kashkari said rates will likely stay high for an extended period of time. Well, Neil, that's probably not going to happen when you vote for rate cuts when the economy lapses into a recession over the next couple months. I bet you won't be thinking that. As some banks have experienced an increase in commercial real estate loan delinquencies, which we've warned about, although delinquency rates are generally remain low, at least from the moment, we could see declines in property values, reduced rental income cash flows, and other conditions that could lead to an impairment of some bank CRA loans or portfolios, and would obviously drive them into insolvency, especially if these loans mature and are refinanced at higher rates. The problem is they're not going to get refinanced at higher rates. That's the thing the Fed doesn't understand. If the buildings lose value, that means the person who owns it is unlikely to bring cash to the table. They turn the keys to the building back over to the bank. The bank has to eat the loss, and the banks are already hemorrhaging. These small and mid-sized banks, these regional banks, are already insolvent and owe the Fed over $100 billion. Where are they going to get that money? We don't know. They're certainly not going to have the money to fix the commercial real estate problem. Bowman also noted signs of low liquidity in the Treasury market. She added, ultimately, liquidity in the Treasury market has the potential to amplify or dampen shocks to the financial system, which also means that if some crisis hits, that rates could come crashing down faster than anybody possibly believes. And it's just too early to think about cutting rates. This from Logan. She said Friday at an event in New Orleans, we need to see some of these uncertainties resolved about the path we're on, and need to remain very flexible to the policy and continue to look at the data that's coming in and watch how financial conditions are evolving. And yet it's very clear, based on the University of Michigan data, they're not looking at the data. They're looking at the data they want to look at. Meanwhile, the Biden administration is now moving into crisis mode as the economy looks set to hit a recession, and that is dangerous news, not just for the administration seeking a re-election, but for the U.S. economy and our labor market as a whole. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.